Good day, dear students. It's me, Dr. A. Sairam, MCom, MPhil, PhD, UGC NET in Commerce, MBA, Post-Graduation Diploma in Financial Management and ICAA Final. Welcome to my channel, Professor Guru Kalvi. This is a channel where you can find the notes and educational tutorials for all commerce related subjects. Come now, let's get into the video. In today's video, we start the UG Corporate Accounting first unit or the topic, which is amalgamation, absorption, internal and external reconstruction, where we will be looking at the meaning of amalgamation, purchase consideration, types of purchase considerations. Then we will be looking at types of amalgamation and how it is accounting, journal entries in the books of buying company, journal entries in the books of selling company. Then we have a balance sheet and calculation of purchase consideration. And as far as internal and external reconstructions are concerned, we once again will be looking at the conversion of stocks, increase and decrease in capital. Then we have reserve liability, accounting treatment of external reconstruction, so on. So what is amalgamation? Amalgamation is the process of merging or bringing together two or more existing companies and forming a new company. So in case of amalgamation, we have an example here. We have a company X and a company Y, and these two companies will merge together to create a new company called Z, where the identity of X is lost, the identity of the Y is lost. There is no more X and there is no more Y. These two companies will come together and they form a new company called Z. So this is an amalgamation where the identity of the selling companies are lost and a new company by the name whatever they desire is created. Features of amalgamation: assets and liabilities of the old company, that is the selling company, are taken over by the new company, that is the buying company. Dear students, here we need to understand properly. In exam, in question paper, you need to identify who is buying company and who is selling company. That is the first and foremost thing that we need to determine in handling such problems in exams. That is where the journal entries turn relevant and the names of each and every company become so important. So first and foremost thing is to determine who is the buying company and who is the selling company. So always the old company is the selling company who is giving its assets and liabilities to the new company, the desired company. As we saw in the earlier example, X and Y are selling company. The Z, the new company which is created, is called the buying company. The shareholders of the old company becomes the shareholders of the new company. Is it not? But this is once again optional, where the shareholders might be given the option to become the shareholders of new company, or there will be a mutual agreement between the selling companies to create kind of a ratio based on which the shares will be allotted in the new company. So these things that we will be looking at in the types of amalgamation that we will be discussing. Then used to expand business, reduce competition or increase efficiency. Is it not? This is one among the important strategy to expand my business, where when two companies of same industry come together, the synergies of two companies can be utilized better, and the market potential of these two companies coming together and forming a new company ensures that the market potential increases. It reduces the competition, is it not? So these are some of the features of amalgamation. Now we come to the types of amalgamation under accounting standard number 14. Amalgamation in the nature of merger. All assets and liabilities and shareholders are continued in the new company. So the assets of X Limited, assets of Y Limited put together will be shown in the Z Limited, the newly formed company. Likewise, the liabilities of X Limited and liabilities of Y Limited put together, added together, will be shown in the new company. Likewise, the shareholders of X Limited and the shareholders of Y Limited, both the selling companies, will become the shareholders of Z Limited. So this is amalgamation by the nature of merger. Then we have amalgamation by the nature of purchase. One company effectively purchases the other. And may not be complete. So in this case, the terms and conditions of one company effectively purchasing, it is not termed as purchasing. Do understand here. Here the identity of the two companies are lost. A new company Z is formed. Is that not so? Here it is effectively purchased by the other company and a new company is formed. So in this case, the terms and conditions of the agreement between the two companies who are selling, two or more companies who are selling, is very much essential to understand. Dear students, in examination, in question paper, you need to first read the question properly. Whether it is merger or whether it is by the nature of purchase, that you can understand simply by reading the question, the additional informations that are given in the question. So do not get frightened by the fact that there are methods in amalgamation. Despite this, you need to understand that we need to first identify who is seller and who is buyer. Then second step, we need to read the problem properly and try to understand the terms of the agreement based on which a new company is formed. Purpose of amalgamation: achieve economy of scale, that is where the usage of synergies comes into existence. Reduce competition, that is quite obvious. Expand market reach, potential is increased. Improve efficiency, which is very important, is it not? The employees of one company and the employees of the another company will come together. It will create more kind of a rapport, and it will develop, once again it will develop the efficiency of each and every employees. Then you have tax benefits in certain important cases. Now we come to absorption. This is where we need to first understand what is absorption, then we will distinguish between amalgamation and absorption. Okay. While on the other hand, absorption is the one existing company taking over other existing company and forming a new company. The absorption company loses its identity. So the example that we are going to see, company X absorbs company Y. Only company X continues to exist. Company Y will cease its existence. Right? In case of absorption, one company absorbs, like sun absorbing water. Is it not? In a hot day, when we keep a cup of water, it will get absorbed, it will evaporate, is it not? That evaporation process, how it happens? It absorbs. Likewise, the company X absorbs the assets and liabilities of the another company into its own company. That's where we need to understand the difference between amalgamation and absorption. In case of amalgamation, the selling company will come together and a new company will be formed. But in case of absorption, the selling company will take over the business of Y, that the buying company. The buying company will take over the business of the selling company rather, and it will run on its own banner. Okay. So absorption is to be understood properly, where the new company is nothing but the person who is buying the another company. Then we come across external reconstruction. External reconstruction is a process by which an existing company is closed, it is liquidated due to financial difficulties or reconstruction needs, and a new company is formed to take over its businesses. Shareholders of the old company receives the shares in the new company. So an example, old company X, it is in losses, it is liquidated. A new company Y is formed to take over X business. Company X will not exist on reconstruction. Right? So here we understand that in case of an external reconstruction, the company is first liquidated, then its assets, liabilities and capital is reconstructed to form a new company. Features of external reconstruction. Number 1, old company is closed. By reconstructing the assets, liabilities and the shareholders fund of the old company, a new company is formed. The assets and liabilities are revalued before transfer, mainly done by review a sick company. Shareholders continue with the new company, but once again the terms of the number of shares and the terms of shareholdings will depend on kind of the reconstruction that happens. Now we come across purchase consideration, which is the central element of amalgamation or absorption or external reconstruction, whatever it is. We need to determine at what price it is sold or what price it is bought. Purchase consideration is the total amount paid by the purchasing company to the shareholders of the selling or the transferring company. Where a business is taken over is called as purchase consideration. It is the price of the business being acquired. So purchase consideration is nothing but the price that is paid by the buying company to the selling company to acquire this business. The purchase consideration may be paid in cash or shares, maybe an equity or preference in the buying company, the new company, debentures in the buying company, the new company, or other assets or securities. So these are various types of purchase considerations that are paid. Methods of calculating purchase consideration. We have 4 different methods. First one is lump sum method. An agreed amount is paid by the selling company, by the buying company to the selling company. Then we have net asset method, where the purchase consideration is the agreed value of asset taken over minus the agreed value of liabilities taken over. The difference between the revalued asset and revalued liability is nothing but net asset method. Net payment method, where the purchase consideration is equal to the total amount payable to shareholders either in cash or shares or in debentures by the buying company to the shareholders of selling company. And finally we have stock exchange method, where purchase consideration is the number of shares issued into issue price, where the shares are issued in the new buying company by the terms of the agreement between the companies. So these are 4 different methods in which purchase consideration is calculated, dear students. Once again, please read the question properly. Is it lump sum method? Is it net asset method? Is it net payment method, or is it stock exchange method? First you read the question properly, then alone we can understand what method is that. So as far as amalgamation, absorption or external reconstruction is concerned, reading the question properly is very, very important. Some of the examples of purchase consideration: company X buys company Y. Company X agrees to pay 1 lakh in cash. Right? This is one purchase consideration. Then the other one is 2000 equity shares of 10 each, which is 20,000 in total. So the total purchase consideration will be 1,20,000. So these are some of the basics, theoretical aspects of amalgamation, absorption and external reconstruction, and the methods of calculating purchase consideration. Thank you for this wonderful opportunity, dear students. With the grace of my Guru and his blessings, you all will go to a huge heights and achieve a lot in your life. Thank you.